I somewhat see real estate as almost not a bond alternative, but almost like a utility stock where it's really safe with a very good dividend, right? So it's a safe asset. I know we've seen astronomical growth in real estate values here over the last 10 years. I do think that those are calming down. I think we're going to see a more traditional 3 to 5% year over year growth in real estate, right? But
Yeah.
we're also going to get, whether it's apartment buildings and you're getting the rental income as a dividend, right? Or if you are flipping homes or building from the ground up like you are, right? That one's more of a growth model right there that I really like. And we'll tell you why here in a second.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, welcome back to Decoding Cash Flow. I'm your host Ted Patel, and today we have a special guest, Alan Frank, who's a certified financial planner with a wealth of experience in helping individuals and business secure their financial future. With a keen eye on smart investments and a passion for guiding clients through the complex financial landscape, Alan brings insight that can transform the way you think about money. So sit back, take notes, and get ready to elevate your financial game. Alan, welcome to Decoding Cash Flow. It's a pleasure having you here.
Thanks so much for having me, Ted. Really excited and ready to have some fun with you here today.
All right. Okay. So, Alan, before we get into more details, if you can
Yeah,
share a little bit about your journey to financial planning, what
yeah.
inspired you to become a certified financial planning, and what did you do before that?
That's right. Yeah. So this is the only thing I've ever done, Ted.
All right.
I've been doing this for 15 years. I studied economics at Mercer University in Macon, Georgia. Graduated in 2010 into the depths of the recession. And so realistically, I got into this profession out of necessity. There really wasn't any other jobs. I had lined up a job with Lloyd's of London in London, and that fell through the financial crisis. I thought I was
Mhm.
maybe going to go the consulting route, but there were not really any jobs there either. So I think we sometimes forget how big of a recession '08, '09, 2010 was and how bad the job market was during that time. But the truth was is that my father had actually laid the groundwork for me becoming a financial planner years and years in advance. And he did such a good job of teaching me a financial education. And I'm so thankful for that gift, right? And he did things like he would bring me to appointments with his life insurance agent, and I'd be
Mhm.
looking at these illustrations, not knowing what the heck I was looking at, but I was learning how to shake people's hands and look them in the eye. He'd bring me into meetings with his investment person. I didn't know what was going on, right? But still, it was about being in the board meetings, right? And expecting
Yeah.
that that's what we do, right? But the best thing he ever did was he bought this board game called Cash Flow, a Robert Kiyosaki Rich Dad Poor Dad board game called Cash Flow. And if you're listening to this, you want to know how do you teach your kids finances? I want to let you know if you tell them it's going to go in one ear and out the other, you got to show them, right? You have to show them here. They're watching more than what you expect, right?
Yeah.
But the one way that you can interact with them is buying Robert Kiyosaki's Cash Flow board game, right? And playing it on a Saturday with all the siblings. It's so much better than Monopoly. I think Monopoly is an awful game. Cash Flow is so fun here, and you're not fighting at the end. There's a clear winner. It's going to take you 2 to 3 hours, but there's a lot that you can learn in that game. So, anyways, that's where it started. Was watching my dad go and buy rental properties, right, to run businesses. Taking me in on these meetings, playing Cash Flow, the board game. And that eventually led to me studying entrepreneurial management and then eventually economics and getting into financial planning.
All right. So, what is the one lesson that you have learned, right, over the years that has shaped your approach to the financial advising? Anything that you'd like to
Yeah,
highlight? Yeah.
yeah, absolutely. Right. So obviously, we're here to talk about alternative investments. And
Yeah.
my dad was a business owner. He liked tangible assets. He liked running his own business. He liked owning real estate, things of that nature. And by
Mhm.
the way, I love that too. I have multiple businesses. I've got multiple real estate properties. But the one thing I had to learn, this is going to sound crazy, I had to learn how to trust the capital markets. I had to learn how to trust the stock market, right?
Mhm.
And it took me a while, particularly after what I saw in 2008, that really kind of scarred my view of what the stock market can do. And what I've realized since then is that it's probably cost me hundreds of thousands of dollars by not trusting the stock market beforehand. But what I've learned is that you can do both. You can do both the stock market and real estate and you name it, right? It's about
Yeah.
diversification of asset classes, right? We shouldn't all be in real estate. We shouldn't all be in the stock market. We shouldn't all be in business ownership. We shouldn't all be in cryptocurrencies, right? But having a multitude of asset classes here can be done. And that's what I've learned is that the biggest cost to any investment is the opportunity cost of what you could do elsewhere with that money. And so
Yeah.
my job as a financial advisor is to show you how to lower that opportunity cost.
Mhm. Now, that is a good point, right? Diversification. That's the thing that you 100% have to implement, regardless
Yep.
of, so because the thing is, you can never, as you said, you can never trust the stock market. One day it's up, one day it's down. And when you need to pull
Mhm.
down money, what if it is down?
Yep.
So
Yeah,
diversification is the best thing you can do. And nothing better
absolutely.
than, I would say, there are many different avenues, but as you know, real estate, nothing better than that, you know.
Yes, that's
So,
right. And so let's talk about diversification real quick. I do want to just hit on one point. When we are focusing in on diversification with our clients, there's three
mhm,
levels of diversification we focus in on. Number one is stock and bond diversification, and that's really easy to get with today's technology. The
yeah,
second is what we just talked about with which is asset class diversification of not just having stocks and bonds in a 401k, but having assets elsewhere, right? And the third thing is tax diversification. A lot of our clients have tax problems, right? I tell
mhm,
everybody we solve three problems: income tax problems, capital gains tax problems, and estate tax problems. And if you don't have those problems, we like to help you create those problems because they're really good problems to have, right? And there's really cool strategies that we can have to help mitigate those. So when we're looking at diversification, it's not just stocks and bonds, it's also different asset classes and also the way that those are treated tax wise.
mhm. Absolutely. So now, as we touched upon the real estate, right? So I'd like to know, like, how real estate, according to you, fits
Yeah,
in the overall financial planning and how people can leverage their assets,
yeah,
uh, you know,
love
and
it.
accelerate their wealth building.
Absolutely. That's a big thing. How do we accelerate our wealth building and how do we do it in a safe way? Right. So
Yeah.
I do want to share you a little bit about my journey. So I have six rental homes. Okay. And we started by house hacking. We bought a house, we lived in it, and then we bought a rental home, and then we eventually bought an Airbnb that we loved so much that we moved in. And then we bought another home to eventually be an Airbnb. So we've got a couple of long-term rentals, a couple of executive midterm rentals, and a couple of short-term rentals. And I'll be honest with you, I'm about rented out right now. I don't have enough to have a property manager, right? So and also I'm not. I think that that market's dried up a little bit right now. I think you're hard pressed to find a home in today's markets with today's interest rates that are really going to be attractive and
Yeah.
cash flow at all, right? So what I've done since then is I've kind of seen the light and I've really pivoted to becoming an investor, right? So when I say business owner versus investor, what I mean is, okay, when you buy a rental property, you're a business owner. You're the landlord, you're the plumber, you're the handyman, right? Or at least you're the general contractor that has to, do all this stuff.
Yep.
You're a hotel guest, making certain your tenants are happy, right? But when I send money to Ted to do an Ashtray Capital to do what they do best, all I've got to do is sign a DocuSign and send some money. That's all I've got
Yeah.
to do. And I don't have to
Yep.
worry about the plumbing issues and the general contractors and the price of stuff that's constantly going up, right? And so that's what I've really learned here is that hey, as my life has gotten busier and I've got a 14, 15-month-old daughter running around her house and I've got a son coming in June. And, not only that, my main business is making a lot of money and I don't want to take any more time from that, right? I've found that, hey, being an investor rather than a business owner is a really good thing for me right now. So that's what I've done for myself in my personal life. But
Mhm.
your question is, hey, how does that fit into an overall financial plan? All right.
Yeah.
I somewhat see real estate as almost not a bond alternative, but almost like a utility stock where it's really safe with a very good dividend, right? So it's a safe asset. I know we've seen astronomical growth in real estate values here over the last 10 years. I do think that those are calming down. I think we're going to see a more traditional 3 to 5% year over year growth in real estate, right? But
Yeah.
we're also going to get, whether it's apartment buildings and you're getting the rental income as a dividend, right? Or if you are flipping homes or building from the ground up like you are, right? That one's more of a growth model right there that I really like. And we'll tell you why here in a second. Um, but as we are looking at real estate, I like it because in general, real estate is safer and in general, it produces some sort of income stream, right? And the way that I like to put it into a financial plan is I actually don't like to put my money directly into real estate. What I like to do is I like to borrow against my other assets. I like to use lines of credit, okay, to leverage what I have a little bit so I can take that money and go leverage other people's knowledge and expertise and maybe even other people's money, right? So the
Yeah.
most common line of credit would be the home equity line of credit. Right. So, Ted, if you think about the equity in our homes, it is earning what we call a blue Tarski. All right. Now, what is a blue Tarski? Well, blue Tarski is a character from Animal House, and his GPA was 0.00. Right. And that's what the equity in our home is earning us. Sure, the home's going up in value, but the equity in there's not doing anything for us, right?
Anything.
So what I
Exactly.
like to encourage my clients to do is go get a home equity line of credit. Now, when I mention that, they're scared. They're like, "What? Leverage our home? That's how 08 happened, right?" So the first thing I do is I tell them, "Hey, no, the home equity line of credit is a security blanket first and foremost. You just got access to, let's say, $250,000 of a line of credit. Okay. That made you $250,000 more liquid. That makes you $250,000 safer. Now, all of a sudden, we don't need to keep as much money in cash. We can invest more of it. We can increase the aggressiveness in our investments because the chances of us having to sell while the markets are down are smaller because we have access to this equity in our home, right?
Mhm.
So what I do is to warm my clients up. We sell it as a security blanket. All right. Now, once we get it in force, okay, now it's there. We're not doing anything, but still making us more money because we have less money in cash, more aggressiveness in our investments, earning a higher rate of return over time, right? And eventually, I start warming them up to the idea of utilizing it as an opportunity fund, the opportunity to borrow against it at 7.5 or 8.5, whatever the interest rates are right now, send some money to Ted, have Ted go do some ground up construction and earn you an extra 20 to 25% right there, right? And now all of a sudden we borrowed at 7%. We got an extra 25%. We got 25%. We netted 18% there. Your home equity line of credit went from earning 0.00 to earning you a net of 18% on this, right? I
Yeah.
love that. Now, what we can also do, most people don't understand this, but we also have other assets we can leverage. We can, every single cash value life insurance, for example, has a built-in line of credit. The interest rate on my cash value life insurance right now is the lowest interest rate I have. It's at 5.5. Beautiful. I love that. That's a great line of credit.
Yeah.
You don't even have to pay the interest on that line of credit. It just collateralizes the interest into the loan, capitalizes the interest into the loan here. And so we don't even have to pay that one back, right? And then we also, and this is one that most people don't know, we also have the ability to go get a securities backed line of credit against our investments and our bonds, against our stocks and our bonds, right? So one of the things that I like to do is throw a lot of my extra money into my portfolio portfolio, my taxable portfolio. We can't do this with investment 401ks or IRAs, but
Hmm.
we can throw this into our taxable investment account, have a securities backed line of credit, and borrow 50 cents on the dollar to go send to Ted. So now all of a sudden, we've got our money in the market. As long as we get a 7% rate of return over time, it's going to double every 10 years, right? So let's say for
Absolutely.
easy math, we have 200 grand in there. All right. In 10 years, it should be 400, in 20 years, 800, and 30 years, 1.6. Okay. It's doing its thing. It's well diversified. In general, it's going to go up, it's going to go down, but in general, over time, it's going to double every 10 years. But we're going to borrow against that at 7.5%, send money to Ted over here to go earn me 25%. And now all of a sudden, instead of having $100,000 working for me, I have $150,000 working for me. Right.
Yeah.
And that's how wealthy people invest here. They don't just put their money in the markets. They put their money in the markets. They have a line of credit, and then they're going to borrow against that line of credit to go invest in real estate and businesses and things of that nature. Right. But I do
Yeah.
like real estate for two reasons. Number one, it's safe. Number two, in general, it produces an income stream that income stream allows us to pay off that line of credit that's there. And the idea would be, hey, by the time we get to retirement, our investments have been doubling every 10 years. As they double, are going to have a larger line of credit to pull from. We go do other private placement deals like the one with Ted. And then over time, we're taking the excess money to pay off the loan. So hopefully by the time we get to retirement, we've got a lot of money with Ted earning us money. And then we also have our taxable investments that are liquid there.
Yeah, that was awesome, man. That was awesome. That was a great insight on how you can put money to work. Just don't keep it lying there. Just take it, use arbitrage it, take
Yes.
the spread of the profit, and
Yes.
here we go.
Well,
So
Ted, and some people would say, "Oh my gosh, that sounds aggressive. That sounds risky." Let me tell you something. It's actually safer to do it this way. All right. So
yeah,
let's say that somebody puts money into a business and that business goes under. They put 100 grand and that business goes under. Okay. Well, they didn't just lose $100,000. They lost the opportunity cost of what that money would be if they would have invested it. So let's say
yeah,
they lose that money over 10 years. What's that? On paper, it looks like they lost 100 grand. Realistically, though, as I just said, if they'd invested it, it would double and it would be 200 grand, right? So what we're trying to do here is eliminate and mitigate the biggest cost of any deal we do, which is the opportunity cost, right? So we put
yeah,
100 grand over here, we borrow 50 grand, and hey, even if this deal over here doesn't work out the way that it's supposed to, at least we have the money in the market doing its thing over there. So I almost look at the market almost as a safety net here. Like, hey, we know over time, as long as we don't freak out when the markets are down, that it's going to do its thing, right? So the truth is that we're eliminating the opportunity cost. And the bigger truth is that wealthy people understand how to utilize and leverage debt. Most people do not.
that's true. And the other thing I would like to add is, in addition to the line of credit as well as borrowing against the insurance or securities, uh, people can also borrow against a 401k.
Yes.
That's the other avenue where you can
Yeah.
pull the liquidity and just try to, use it in the best possible manner.
Yeah, absolutely. I believe it's the max is 50% or up to $50,000 there, and the loan provisions are pretty similar to what you would have otherwise, right? So
Yeah,
that's an extra $50,000 of liquidity that you can have. Absolutely.
yeah. All right. So, like the other thing is, you have been doing this financial planning for quite some time, right? So, what have you seen like the biggest financial mistakes that people do, and how they can avoid them, I would say.
Yeah. I would say this, it pays to be optimistic. Okay. The
Yeah.
biggest financial mistakes I've seen have been from being scared and too conservative. All right.
Yeah.
It pays to be optimistic here. So we've run in, particularly when I started in 2010, we ran into a lot of what we call doomsdayers, right? That lost a lot of faith in just the general, lost faith in America frankly, right? Lost faith
Yeah.
in the economy, the markets, lost faith in America there for a little while, right? And so, and so they're always like, what if? What if this happens? What if this happens? What if this happens? Well, hell, let's change the narrative here, Ted. Hey, what if
Yeah.
things go up? What if things get better? What if this works rather than what if we enter into a civil war? Like, well, what if we don't, right? Because the chances are we're not, right?
Yeah.
What if this thing works out? Because chances are it will, right? And so the internal dialogue that we have in our head, by the way, this is natural. This is human evolution here, right? That good things that happen, right? Our job as humans at the innate core is to survive and produce, right?
That's
That is it.
hmm
That is natural evolution right there. Survive and produce, right? Well, what if there's not a lion over there? Well, that doesn't keep us alive. What if there's a lion over there helps keep us alive, right? So we are not innately here to strive and thrive here. We're just here to survive, right? So that's why it's so hard for a lot of people. Now, there's people like me and you and the people listening here that they're not said, I'm not here to survive. I'm here to thrive on this, right? So they're
Yeah.
thinking about, well, what if things work out? So the biggest mistake I've seen is people being pessimistic, and therefore when things don't go right, they freak out. They're looking for things to go wrong. Then they don't act prudently when things do go wrong. They freak out, right? So what
Yeah.
I've learned is that because I used to be one of these. When I first got in, I was a doomsdayer. I was so afraid of everything, right? But what I've learned is that it cost me a ton of money being that way. And what I've learned is that in general, things get better over time. They might not seem like it. They might,
Yeah. Yeah.
right now is kind of an interesting time in history. There's a lot of stuff happening right now, right? But in general, over time, things do
Things.
get better, right? And so, I would say the biggest thing that I've seen is just people being pessimistic. Because the truth
Mhm.
is, game theory here. Let's talk about game theory. Let's say things do get worse and you were right. Okay, right. Well, guess what? If stocks aren't worth anything, and if there's an apocalyptic event, you're not only your stocks not worth anything, but neither is your cash underneath the mattress, neither is your cryptocurrency, right? Like, yeah, if things really go bad, all you get to say is, look, I told you so. And guess what? Nobody's going to be here to care, right?
Yeah.
But what if things go right? Right. Well, what if we were to be aggressive and things go right? Because that's probably what's going to happen, right? Now, all of a sudden, when you say, hey, I told you so, and I've got all these homes and I've got all this money and I'm having this great life. So, in general, it pays to be optimistic.
Yeah, that's what I always say. The biggest mistake in your life is not taking action, to be on the sidelines. That's the worst thing you
Totally.
can ever do. As in the stock market, right? People say bulls make money, bears make money, pigs get slaughtered. That's what it
Yeah.
is. Yeah.
Yes, I love
So,
that. I
yeah.
love that. Yeah. Too many people are backup actors in their own life. Like you need to be the main actor in your movie, right? You
Yeah.
need to assert yourself and insert yourself into life here. We only have one of these things, let's live it.
Yeah. Absolutely. All right. Hey, Alan, before we started the podcast, right? We discussed about one of your book, Empowered Money. Can you tell us a little bit about what that book covers? Just a
Yeah.
summary? Yeah.
Yeah, so I felt this huge need to write a book. I felt a huge need. I really love financial education and I really love empowering people through education. And so I felt this responsibility to write this book. And I tell you what, I did not write it for. I did not write it for money at all. I'll be honest with you, I'm so in the red on this book right
hmm
now. And that's without even counting the amount of time I spent, right? Because we wanted to do it right. We wanted it to look good. We wanted it to be correct, accurate. So we spent a lot of money on editors and graphic design artists and things like that. But yeah, so I just had this gnawing at me that, hey, it is my duty. I owe this to people to write this book. And so what I did is I wrote a book that is geared to help somebody go A to Z on a financial plan from the
Hmm.
very beginning of goal setting. So what we do is we lay it out. And by the way, guys, this is the exact stuff that I charge people $5,000 to work with me on, and you can get it $20 in this book. It is everything I've learned over 15 years is in this book right here. But we
Hmm.
start at the beginning of, hey, why is financial planning important? Right. Well, it's important because it's the one thing in your life that if you get right, it makes everything else in your life that much better. Right. Helps you sleep better at night, knowing that you're secure. It helps you wake up in the morning, knowing that your tomorrows are going to be better than your yesterdays. Helps your vacations be more fun, your family be more together. Right. So we start there, and then we get into the weeds. We look at the cash flow. We look at how do we build up our cash flow? How do we reduce our expenses here? On the risk management side, we talk about, okay, hey, what do we need to choose from an employee benefit standpoint? What do we need from an estate planning standpoint? What do we need to do to price out our car and our home insurance every single year? Hey, life insurance. There's a lot of noise out there, right? How much life insurance do I actually need? What type is best for me? What company is best for me? So we walk through all of that, and then we get to investments and everything we've already talked about with investments and helping people get over their fear of investing. And then my favorite chapter, debt and leverage, right? We talk about this same exact stuff here on debt and leverage, and then we wrap it all up. So the idea here is that we go step by step here in creating a financial plan. So by the end of it, you've got a really good track to run on here.
Hmm. Awesome, man. We'll make sure, we put the link of this book in our podcast when it goes live. But yeah,
Yeah, yeah.
so
And I think
that's a great.
And I would say this, the principles in there are true for anybody at any age, at any stage in life. I will
Hmm.
say this, if there's anybody who's got a graduating college person or a young or a child that they're trying to learn financial planning, it really is geared towards that person that's maybe starting out on their financial
Hmm.
journey. Once again, it's good for anybody. It's an easy read. It really is. I've had people say they pick it up and they can't put it down, and maybe they're just being nice to me, right? But it's a real book with real content. It's not a fluff piece, but it's still an easy read, and it would be really good for people that are getting started on their financial journey.
Hmm. So talking about that, right? I had one question in mind for you, which was like, if what is the advice that from you for someone who is just starting their, journey, like 20 years old, college graduates, uh,
Yeah.
something just starting their financial journey. What is your main advice? Like the first initial planning, of course, it cannot be told in like it can go, we can talk about it for hours and hours, but just if you want to just summarize it in few lines or few sentences, what.
If I were to meet with somebody just starting out, I would say, hey, the first thing you got to do is you do have to get your emergency fund built up. I know it's painful, I
Mhm.
know it's boring, but we do need cash on hand, right? I want you to be able to sleep at night. So whatever 3 to 6 months of your expenses are, I think that that's the first thing that we do, right? Now, I would say this, I would go ahead and select that little button when you get your first job to put into your 401k. Because when we look at building wealth, there's really three ways to build wealth. The first way is through the stock market, and that's the most common way because it's so easy to click on the 401k, your
Yeah.
company matches, hopefully, right? And then that gets that kick started. The second way is through real estate, right? And just as long as you owned your home, if you owned your home over the last 5 years, your net worth is really taken off just by owning real estate, right? I'm not even talking about investing with Ted or I'm not even talking about having rental homes. I'm just talking about living in the place that you owning the place that you live in, right? And so real estate's the second way to build wealth. The third way to build wealth is starting and selling a business. And that one's exceptionally hard to do, right? But maybe if you're at a company that offers stock options or something like that, you can participate in that deal, right? But with knowing that those are the three ways we can build wealth, I do want to just reiterate the first thing we got to do is get an emergency fund. Go ahead and click that, do the 401k match. Once you reach that emergency fund, maybe we want to then build up some taxable investment money because that's a bit more liquid. So maybe like
Yeah.
3 months of expenses in cash, another 3 months in a taxable investment account. And then once we're there and we're liquid, maybe we go and we try to up that 401k a little bit. Maybe we do a Roth IRA as well to get money into something that's never going to get taxed again, as long as we
Mhm.
wait till 59 and a half to access it. So I will say this, it's a constant battle between tax advantages and liquidity on here, right? Tax advantages and liquidity. And the good thing about the taxable investments that are liquid is once again, we can utilize that for stuff like real estate here. So there's there's a lot of ways to build wealth, but in general, it all starts with keeping a good eye on your budget and understanding that magic is in the margin here. The
Yeah.
difference between what you bring home after taxes and what you make. That's where the magic happens. So, how do we bump up your income over time? By showing up on time, by asking good questions, by going and get designations, maybe an MBA, whatever it is, driving revenue there, and obviously keeping a good life is expensive and we want you to live life, but keeping an idea of where your money's going, right? As the bigger of a margin we get, the faster we can build up cash, the more we can save, the quicker we're going to have the fundamentals to be able to
Yeah.
invest with people like Ashtray Capital.
Love it, man. Love it. That was a really great advice, you know. And as I'm always about liquidity. Always keep the liquidity because you never know when the opportunity arises, you know. And
Yeah.
li- so
Yes. And the thing about liquidity, Ted, is if you're liquid, the opportunities find you, right?
yep.
So we've got a saying, we want to be liquid but not lazy, right? So let's
Mhm.
take a look at a high yield savings account. It earned 4.5% last year. That's the best that cash has earned in a very long time, right? Well, the markets earned a lot more than that, right? So even in cash's best year, the markets destroyed it. Okay. So having too much in cash is still lazy. It's liquid, but it's lazy,
Yeah.
right? That is where the lines of credit come in. We can be liquid, but not lazy. And I will say
Yeah.
this about having too much cash on hand. When we have a ton of cash on hand, maybe that new car that looks really sexy, maybe that seems a little bit more doable right now. Hey, if we got $250,000 in cash, maybe we do go spend 75K on that new car, or maybe we do go take that vacation without thinking twice, right? So when we've got a
Yeah.
lot of money in our bank accounts, we tend to spend it, right? We tend to eventually will evaporate, right? But I will say this, not many people are going to borrow against their home equity line of credit to go on a vacation. Right.
Yeah.
Not many people, it separates it just enough where we're not going to borrow from our HELOC to go get a new Ferrari, right? Or the new Lexus that's out there, right? So we like to be liquid but not lazy, and that's where those lines of credit come in.
Yeah, absolutely true. You only normally if you have a line of credit or 401k, if you want to borrow, right? You only try to borrow where you have a more opportunity cost. You know, you have more leverage, you got more return of investment, you know, you have better spread on the return. You don't borrow just to have fun.
You do not. You do
Yeah,
not. And we've had people do that in the past and regret it, right? So we had
yeah,
somebody borrow money to finish off a basement. All right. And yeah, they at the end of the day they had a new basement. Their home value was more because of it, but it didn't return an income stream. So they had to go and pay off that line of credit. So
yeah,
when I am lending money, I try to follow two rules. Number one, it needs to be a safe investment, right? I'm not borrowing against my investments to buy more investments,
yeah,
right? I like to buy stuff that's a little bit less correlated to the capital markets, right? So number one is I want it to be safer. Number two is I want it to produce either an income stream for me or I want it to have a quick turnaround. Okay.
hmm,
So when we talk about diversification, the one thing that's kind of hard to do is diversify in private placement real estate. Right. So it's really hard to diversify. Okay, so you go buy one rental home. All right, that's kind of risky. You have one rental home, right? One asset
yeah,
right there. Um, so if you go and you invest into a private placement group, sometimes their minimums are $250,000, right? So it's hard to get a lot of those, right? But
yeah,
what I've realized here is that when I'm investing in private placement real estate deals, I like to have a good balance of being on both sides of the balance sheet. And what I mean by that is I like to lend some money and then I like to be the equity position in some money. All right, so let
Hmm.
me give an example here. Where my wife and I are invested in a 130 unit apartment complex that is going to be just an absolute gangbusters investment for us. But it was supposed to break ground last March, not this March, last March. It's probably not going to break ground until September. Okay. Now,
Hmm.
that means over the last year and a half, I borrowed from my life insurance to do this, right? So I've been paying interest on this for a year and a half. Right now, my equity is growing. The longer it's actually works out better for me, the longer it takes, the more equity I'm going to get in this thing before they break ground. But still, I've had to pay, let's call it 1,200 bucks a month of interest every single month, right? So what I've been, and I this was an accident, but I really like how it worked out. What I've also done is I went and lent money through hard money lending, right? So I borrowed
Hmm.
against my investments at, let's call it 7.5% interest. I lent it out at 17.5% interest. So I'm getting a nice little spread of 10% right there. Well,
Hmm.
I've been able to use that income stream to help offset the payments on my other lines of credit that I have out there, right? So when we're thinking about diversification, we typically don't want to go all in on one thing, right? We typically want to, do 50 grand here, 50 grand there, 50 grand on
Yeah.
that project, right? But we also might want to be on both sides of the balance sheet, some where we are equity owners and it's a little bit more tax efficient over there on the equity ownership side,
Yeah.
and then some where we are lending. The only problem with the lending side is that is taxable income, and a lot of our clients are already in a pretty high tax bracket, right? So we got to be careful there. But having the combination right there has been a really good diversifier and helped me pay for some of the interest on the lines of credit.
Very true, man. Love it. So, Alan, loving this conversation, but also want to be mindful of your time. So, would like to move to the final round of questions. Are you ready?
Yeah, so Ted, I need you to test for me. I have no clue what you're about to ask me, right? You offered to give me the questions and I said no.
It. I'm pretty much sure you'll ace every question, so I don't have to worry about it. Yeah. All right, Alan. So the first one, which is the one book that had the most impact on your life or on your business?
Yep. Science of Getting Rich, Wallace D. Waddles.
All
That's my Bible
right.
right there. I love it. If I'm
Great.
ever in a bad mood, I pick up that book, I read a couple chapters, gets me in the right. I'm a big believer in wave frequency, right? And
Mm-hmm.
energy frequency, and that gets me in the right mood right there.
Awesome. All right. What are your main source of information to learn and grow?
Books, 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 books. Obviously, I love listening to podcasts in my free time. I
Mm-hmm.
think that we have forgotten about the therapeutic aspect of reading a book and not having, we live in this world of so much stimulation, but being able to
Yeah.
sit down for 20 minutes, not on an iPad, on an actual book, and being able to read, get rid of all the other stimulation and focus in for 20 minutes or so. I think that we've forgotten how therapeutic that can be. So, yes, I do love podcasts. I love YouTube videos, no doubt. Shoot, ChatGPT is a great source of information now
Yeah,
too, right? But I love books.
that's true. Yeah, therapeutic benefits that you say, right? When you when you go to bed, just read few pages of book. It will help you get a good night's sleep. That's what I have
Really
been
well.
observing. Yeah.
Yep.
All right. Which is the one habit or routine which has been crucial to your success?
Hmm, that's a good one. That's a good, and it changes with um, different life stages of life. I want to give you two that I've started here this year that I really like.
Mhm.
Number one, I do have a journal that I write in every night, and I write down my 3 wins of the day and my three
Okay.
wins for tomorrow. Okay.
Hmm.
Because it
Okay.
changes my aspect on it. Oh, it's almost like a gratitude journal, right? But it's the 3 wins of today and the 3 wins that I expect to have tomorrow. And so it kind of gets me, it gets me once again in the right mood, gratitude mood,
Yeah.
right? So that one has been super helpful. The other one, and this is a new one I've done this year, is I created a vision board, and I realized that this is nothing new, but it's really the first time I've executed on it. I created a vision board, and then I printed out about 10 copies. I've got one in my home office, my actual office, one here in my gym. I've got one in my closet. I've got one in my car. And so it's just everywhere I go, I see it, right? I see
Hmm.
it. At this point, I can resuscitate exactly what it says. But this is the first time that I've actually executed on a vision board. So those are two habits that I've started this year and I'm really liking.
So, right, the vision board, right? It get once you keep accessing it, looking at it, it just gets into your subconscious mind. You start acting accordingly, you know. It just
You
changes
got
the
it.
behavior pattern and everything. Yep. So, final question. That's the most, I would say the toughest question actually, you know. How can decoding cash flow listeners get in touch with you?
Great. Great. I love that question. All right. So, my website is empowered-money.com, empowered-money.com. And if you go there, you are going to see a few things. Number one, you're going to see a link to buy our book. Number two, you're going to see a link to a free 10-minute financial plan. I recommend you fill that out. It's a great way to see your current trajectory there. It's quick. I say 10 minutes, probably less right there. And I do want to warn you that, hey, if you do that, we are going to capture the lead and we probably will reach out to you on that one, right? But what's cool is if you wanted to reach out to us and you fill that out, then we can actually have a good conversation that first time of how we might be able to add some value to you. But also on there, you're going to have the ability to schedule a meeting directly with me on there. Now, what you're also going to find, you're going to find my podcast on there. You're going to find my news bits when I've gone on local news here. You're going to find articles that we've written. So there's a lot of really good content in there. But empowered-money.com, empowered-money.com, that's where you're going to be able to find me.
Awesome. All right, Alan, it was a pleasure talking to you. Thanks for taking out some time and coming on the show.
Ted, thanks so much. Let's do it again soon.
Yep, sure.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.